Today's topic is the structure of the Forex market. In this chapter, we will learn about the structure of the Forex market. The structure of a typical stock market is as shown below. Buyers, centralized exchanges NSE, BSE, NYSE, seller. But the structure of the Forex market is rather unique, because major volumes of transactions are done in over-the-counter OTC market, which is independent of any centralized system exchange as in the case of stock markets. The participants in this market are central banks, major commercial banks, investment banks, corporations for international business transactions, hedge funds, speculators, pension and mutual funds, insurance companies, Forex brokers. Hierarchy of participants. The Forex market structure may be represented as shown below. Major banks: electronic broking services (EBS), Reuters dealing, 3000 spot matching, medium-sized and smaller banks, retail market makers, retail ECNS, hedge funds and commercial companies, retail traders, market participants. In the above diagram, we can see that the major banks are the prominent players and smaller or medium-sized banks make up the interbank market. The participants of this market trade either directly with each other or electronically through the electronic brokering services, EBS or the Reuters dealing, 3000 spot matching. The competition between the two companies, the EBS and the Reuters 3000 spot matching in Forex market, is similar to Pepsi and Coke. In the consumer market, some of the largest banks like HSBC, Citigroup, RBS, Deutsche Bank, BNP Paribas, Barclays Bank, among others, determine the FX rates through their operations. These large banks are the key players for global FX transactions. The banks have the true overall picture of the demand and supply in the overall market, and have the current scenario of any current. The size of their operations effectively lay down the bid-ask spread that trickles down to the lower end of the pyramid. The next tier of participants are the non-bank providers such as retail market makers, brokers, ICAs, hedge funds, pension and mutual funds, corporations, etc. Hedge funds and technology companies have taken significant chunk of share in retail FX but very less foothold in corporate FX business. They access the FX market through banks, which are also known as liquidity providers. The corporations are very important players as they are constantly buying and selling FX for their cross-border market purchases or sales of raw or finished products, mergers and acquisitions, and they also create significant demand and supply of currencies. Sometimes, governments and centralized banks like the RBI in India also intervene in the foreign exchange market to stop too much volatility in the currency market. For instance, to support the pricing of rupees, the government and centralized banks buy rupees from the market and sell in different currencies such as dollars. Stay tuned. Be continued. Like and subscribe.